Deep understanding of the supply and demand of money. Introduction in a modern economic system. Money is not only used as a medium of exchange, but also as a means of storing value, a unit of account, and a legal tender. However, the role of money in the economy is not limited to its function. The amount of money in circulation and how people use it can affect inflation, interest rates, economic growth, and monetary stability. Therefore, understanding the supply of money and the demand for money is very important, especially in the context of monetary policy. 1. Money supply. Definition. Money supply refers to the total amount of money available in the economy at a given time. This includes currency, banknotes and coins held by the public. Demand deposits. Bank deposits that can be used at any time via check or debit card. Money supply. Classification in economics. Money supply is often classified based on its level of liquidity. M0. Physical money in circulation, currency. M1. M0 plus demand deposits. M2. M1 plus time deposits, savings, and other money market instruments. M3. If used, M2 plus less liquid financial assets such as large deposits and securities. Who controls money supply? The money supply is controlled by a country's central bank. Examples: Bank Indonesia, BI, in Indonesia, Federal Reserve, the Fed, in the United States. The level of trust in the banking system. If people do not trust banks, they tend to withdraw their money, reducing the effective money supply. 2. Money demand. 1 definition. Money demand is the desire of people to hold money in the form of cash or highly liquid bank deposits, rather than in other assets such as stocks or bonds. Theory of money demand. According to John Maynard Keynes, the demand for money consists of 3 motives. 1. Transaction motive. People need money for daily transactions. 2. Precautionary motive. Money is saved for unexpected needs, e.g. illness, accidents, etc. 3. Speculative motive. Money is saved because people predict that bond or stock prices will fall, interest rates rise, so they wait for the right time to invest. Factors affecting money demand. Income level. The higher the income, the greater the demand for money for transactions. Price level. Inflation. High inflation causes the need for cash to increase. Interest rate. High interest rates encourage people to save money in banks, investments rather than saving it as cash. Banking technology and payment systems. Advances in electronic systems reduce the need for cash. 3. Money market equilibrium. The money market reaches equilibrium when money supply equals money demand, because the money supply is usually set by the central bank, with a vertical curve to the interest rate. The interest rate is adjusted to achieve equilibrium. If there is an imbalance, supply, demand, excess money, right pointing arrow, people buy bonds, right pointing arrow, prices rise, interest rates fall. Demand, supply, lack of money, right pointing arrow, people sell bonds, right pointing arrow, prices fall, interest rates rise. Graphic illustration. Usually depicted in a graph with x-axis, amount of money, y-axis, interest rates. The money supply curve is vertical, because it is fixed. The money demand curve slopes downward, because interest rates are higher, right pointing arrow, money demand falls. 4. Real example. Indonesia, 1998 monetary crisis. Bank Indonesia printed a lot of money to help banking, right pointing arrow, high inflation, right pointing arrow, the rupiah exchange rate fell. COVID-19 pandemic. BI lowers interest rates and buys government bonds to increase liquidity, right pointing arrow, boosting growth but with inflation in check. 2022-2023. Global monetary tightening by the Fed forces BI to raise interest rates to maintain rupiah stability.